Hey, good morning, everyone. Good morning.
Good morning, Professor.
Hey, good morning, Anna. Good morning, Ethan. And good morning, Yan Chu.
Good morning.
Good morning.
Good morning, Ethan. Yeah, hi. Alrighty. I see only, okay, I'm seeing, good morning. I said too, good morning. I see only four of you. Well, we're almost we're almost nearing the end of the semester. I mean, we still have 4 weeks left, I believe, 4 more classes. But you know what? We're almost there, and that doesn't mean that shouldn't be the reason for cutting class. But let me just check how many are in the discussion board. Okay, I have 4 people in the discussion board, and so I have 4 and 4, so that's pretty much everyone. And if your name is not here, someone here isn't in the Collaborate, and someone in the Collaborate is not in here. In that case, please don't forget, this is your undeniable and indisputable proof of attendance. Nothing else, can prove it. So please, make sure you sign into the today's forum, right? By all means. Now, I have a sort of, bad news. Bad in the sense, not uh, uh, not a like a disaster, but yeah, it's a personal disaster. My computer crashed Tuesday this week. I still need to get it fixed, and in the meantime, I'm using temporarily my old computer, which runs on Windows 10. So this is a problem because after Windows they terminated the support to Windows 10, and Windows 10 is not upgradable to Windows 11. You have to completely have either install Windows 11 or have a new computer that comes with Windows 11. And this computer I have is more than like 10 years old and just still running on Windows 10. So it's got a lot of limitations. Okay, so especially things like Whiteboard. There's no support for apps like Whiteboard, and it's not touch screen, so there's nothing. I can draw with the mouse, but I cannot actually use a pen or fingertips to write something on the screen. So I'm going to be very limited, and the computer is slow, so it takes a lot of time to do anything. So until I get this my computer fixed, then I'm afraid this is what it's going to be, and I would appreciate if you just bear with me. Of course, it will be just this week. Next week, the computer will get fixed by then. So anyway, and I feel so terrible. I have only 4 people, and then in my Thursday Finance 300 class, it was pretty much the same thing. There were only about 4 or 5 people, and at the end, only 2 people remained, and those 2 people were even unresponsive. So I had to call it a night on Thursday because after about 2 hours, nobody was there. two people were there, but unresponsive. Um, I had to close it a bit early. I hope it isn't going to be like that for today's class. Now, so let's go back to the capital budgeting, that we left off last time. And in capital budgeting, there are four techniques. Payback and net present value and internal rate of return and profitability index. Of these four methods, payback is generally not used that much because of its very rudimentary nature. But however, most commonly used capital budgeting methods are net present value and internal rate of return. So let's see what they are, one by one. First of all, payback period is the time it takes to recover early cash outflows, which means, initial investment. Okay. So it simply means, the time it takes to recover the initial investment, right? So this is very, crude method. There is no consideration for present value of the cash flow. So then this is, very crude and rudimentary. And the decision rule, of course, the shorter the paybacks, the better they are, right? Obviously, if you can recover the initial investment within 2 years, it's better than the project that can recover it in 3 years. So the decision rule is for standalone projects, right? If the payback period is less than the policy maximum period you can allow, you accept it. If otherwise, then reject. So this is quite, standalone projects are quite arbitrary. It depends on the arbitrary policy maximum. And the policy maximum is arbitrary. The mutually exclusive projects, obviously the shorter ones, the better. If payback of project A is less than payback period of project B, of course, then project A will be accepted. So mutually exclusive means only one project can be allowed. I mean, why? Because the budget is limited, and only one project can fit the budget. And these two candidates will become mutually exclusive, right? Now, and the weakness of the payback method is obvious. It ignores time value of money and also ignores cash flows after payback period. Now, think about it. The payback can happen early on. In other words, you can recover two projects. One project, project A, you can recover initial investment in 2 years. Project B, you can recover initial investment in 3 years. And based on this, you choose project A and reject project B. But afterwards, let's say project B generates a lot of cash inflows, whereas project A generates mediocre cash inflows. Then your decision based on the payback is totally wrong, because it's not in the best interest of your company, right? And only considering whether you recover your initial investment or not. That's really nothing but it's not really a smart way of doing, uh, smart way of managing your money, right? In other words, you just simply recover your initial investment without any gains, right? So that's uh, uh, not a very smart move. So here's the let's take a look at the example. So consider the following cash flows, right? So at time zero, $200,000. So that's the initial investment. And it's in the parenthesis, so that means that's the cash outflow. Of course, there must be cash outflow, and then afterwards it will generate cash inflow. First year 60K, second year, all 60K even. Of course, this is too artificial, right? In reality, the cash flow projection would be either in a um, declining pattern, or increasing pattern, or constant, or uneven, right? But if it is constant like this, then it's easy to figure out the payback period. Uh, it's basically expressed in cumulative cash flows, right? And at time zero, at the beginning of the first year, 200K. At the end of, and then at the end of year one, which is at the beginning of year two, right? One means at not the year one. Year one is when time zero starts, right? These are all when the timeline starts, right? Timeline starts at time zero, and then ends at time four. But that means end of the first year must time in the timeline it will be marked as 1, 2, 3, 4. End of year 4 will be marked by 5, right? But we are not going into the fifth year, right? Because 5 only means the beginning of year 5, which is the same thing as end of year 4. So then at the end of year 1, you have cash inflow of 660K. So then cumulative cash flows, net cash flow is still negative because it was 200K, and still negative in year and by year 3, right? Only by the end of year 3 you will you will recover. I mean, from year 4, um, the net cash flow, cumulative net cash flow will be 40K. So basically, by the end of year 3, right, you will have recovered your initial investment. Actually, if you calculate it, the exact one is 3.32 years, right? Because by the end of year 3, uh, there is still your net cash flow is still negative 20K. This negative 20K will be recovered by the first 1/3, by the first trimester, or 1/3 of year 4. So that's going to be 3.3. So uh, this is so boring. uh, then we can compare. Let's compare two projects by payback method. Project A, both of them have 1.2 million. They are, if everything is usually, everything is in thousands, right? The numbers are expressed in thousands, so that would usually mean, 1.2 million and 400K. So whatever, it is 400K. So if you consider by only the payback, then project A is preferred. right? Because by the end of year 3, it will completely recover the initial investment. Project B will still have 50K left. Okay, so you pick project A according to that. And if they are especially mutually exclusive, then you pick project A and reject project B. But then after the payback, think about it. After year 3, then project B is generating a lot more, right? 4 times the cash flow of project A. So then you made a mistake. If you just pick project A because of that, you made a mistake, right? So that is the downside. But despite all its weaknesses, why then do they use payback method? They generally don't use payback method, but if they do, it's easy to for any lay person, right? Lay people who have no training in economics and finance. For them, it's easy to understand because they don't have any concept of present value. So it serves as a rough screening device. So they have come up with some remediation. So now they use a present value payback method, right? But it's not widely used because if they use present value payback method, right? What's the difference between that and net present value? You would rather use net present value method. Again, still, the downside, even if they use present value payback method, the downside is they only look at uh, consider the payback period and they do not consider the cash flow after. So still, still something like this example can still happen, right? So we move on to the net present value, and net present value is easy. We already understand what present value is. So basically, what you're doing is you find the present value of all the cash flows. Of course, cash flow at time 0 is initial investment, and it is already in present value. It's already present value. That's cash outflow. But the rest of them are cash inflows, right? So basically, this would be a negative, number. All the rest are positive numbers. So the criteria is simple. If the present value of cash inflows are greater than present value of cash outflows, then then net present value will be positive, right? And then a project's net present value is the net effect that is expected to have on the firm's value. Yes, in other words, net present value is the like the um, operating cash flow, right, or free cash flow, right, to the firm. So there will be, a cash flow or the return to the investors or the asset providers right? Asset providers are both, equity holders and debt holders because, the capital is, there are only 2 types of capital. Capital is provided either through equity or debt. So to maximize the shareholders' wealth, select the capital spending program with the highest net present value. Yes, yes, it's all common sense. Um, so the decision rule, first of all, if it is a standalone project, as long as the net present value is positive, accept, right? Otherwise, reject. And mutually exclusive projects or competing projects, if you have competing projects, and if you can, if your budget can allow, if your budget can accommodate only one project, of course, the one with the project with the greater net present value will be selected. But if the budget can accommodate multiple projects, right? Then of course you can stack them up. In other words, prioritize. Prioritize by the size of the net present value, right? The greater. So if your project budget is 10 million, and you 10 million can accommodate let's say 4 projects. Those 4 projects will be in the order of net present value. Okay. I mean, depending on the size of the net present value and the size of it could be 3 or it could be 4, right? But the one doesn't fit within and with the lowest net present value, and that if it doesn't fit within the budget, then the lowest one will be dropped. All righty, so let's see how many people are. Still the same number of people, huh? 5. Okay, 5. All right, we have Tyra. So Tyra with Tyra at Soul 5. Let's see how many are here. Okay, I see 7 people. Ethan and Anna are there. Yanchu there. Edwin is not there. I said to here. Vanessa Suarez not here, not in the collaborate. Tyra is here. So 2 people missing still. All right. So everyone has no problem with the
Professor, I have a
audio.
question.
Yes, yes. Go ahead, Tyra.
Did you set a date for the final exam?
I haven't set a specific date, but it will be the last day of class is December 11th.
Okay.
That's class. So it will be normally, the final period will start from like the 20th. No, 13th. 13th. So, but we don't meet. I mean, most classes meet either Monday or Tuesdays. But
Mm-hmm.
your class is not meeting on Monday or Tuesday. So we cannot wait until the 18th. So the final will be then. During the week of Friday, the 10th, December 10th through the 12th, Sunday the
Okay.
12th.
Thank you.
Okay? All right, you're welcome. Any other questions? Not about final, but about what we've covered so far, right? Any other questions? All
I
right.
don't think so.
Okay, I said to. All right, good. Uh, if you don't have questions, I guess most other people wouldn't have questions either. Okay. All righty. So next. So here's an example. Project Alpha has the following cash flows. If the firm considers Alpha has cost of capital of 12%, cost of capital means discount rate, right? Should the project be undertaken? Um, well, so basically, initial investment is 5,000. which is negative, which is cash outflow, so negative, right? And then time 0, of course, initial investment. And then time 1, 2,000, time to 1,000, time to 2,000, 3,000. You just discount it, right, by 12%, 1.1. And, then it comes to negative 377. So this is negative net cash flow, negative net present value. So reject, right? Reject. Next, third method is internal rate of return. Internal rate of return is basically, like the bond yield. Internal rate of return is just the math in compounded compounded rate of return. In other words, mathematically, internal rate of return is the discount rate. That makes the right-hand side equal to the left-hand side. Okay, so in other words, it's just like saying in this problem, we can rewrite this problem like this. I don't have a. I'll have to use. I'll have to use the blackboard. Okay, I mean, a whiteboard on the blackboard. Okay, whiteboard provided by so whiteboard that it's I think Microsoft Whiteboard, which is the whole screen, but this one has a limited screen, and that's why I don't like about it. Even if I expand it to full screen, what's oh, okay. Okay, and let me. All right. So we have actually now net present value was like C0, which is negative, right? C0 is already negative. C0 is because it's cash outflow, and then cash flow 1 over 1 plus discount rate, or the required return for the project C2. This is what I don't like about it. I have to use the mouse, so it's so difficult. That's 1, right? 1 plus R squared. C3 1 plus R cubed, and so on. Okay. Suppose the net present value is 0. Suppose this is 0. Okay, I'll have to put it here. Suppose net present value is 0. What does that mean? If the net present value is 0, you simply recovered your initial investment, right? You simply recovered your initial investment, nothing more. That means then, since this side is 0, right, that means the left-hand side, since the left-hand side is 0, right? So from the right-hand side, you can move C0 to the right-hand side. I mean to the left-hand side. And then the equation will simply look like when you move C0 to the left-hand side, every time. If you move it to the left-hand side, this will be a positive number, right? Now it is positive because it was negative previously, right? And then in the right-hand side, you will have only cash flow 1, discounted, of course, cash flow 2 also. It is so frustrating. One plus R squared. That's cash flow 3. 1 plus R cubed plus. Now, think about it. The net present value can be positive or negative. This thing can be net present value can be positive or negative, right? Either, positive or negative. Because depending on because the discount rate is given. In other words, there's a certain hurdle rate that is already given. So depending on that, the cash inflows will be discounted either greatly or just a little, right? And if it is discounted greatly, most likely it will be the net present value can be negative. If it is discounted just a little, only a little, then net present value will be positive, right? So because R is given already, but then think about it. Given, if discount rate is not given, what is given is okay. So let me. Because R is not given, R is given, rate is given, and then it can be positive or negative. But if the question is, if the rate is not, the discount rate is not given, right? Then depending on what this rate is, net present value can be positive or negative or zero, right? And then the point is, if we write it this way, that means the right hand side is equal to the left hand side. That means all the discounted cash inflows are equal to initial investment. That condition means you just break even, isn't it right? If your initial investment, if all the cash inflows from the project sums up to only the initial investment, right? It sums up to the same number as the initial investment, then the project simply breaks even, right? You just recover your initial investment. And then net present value will be zero because they are left hand side and right hand side are the same. They are equal. Left hand side and right hand side are equal, right? So it all depends on what this discount rate is, and the rate that makes the left hand side equal to the right hand side, right? The rate that makes the right hand side equal to the left hand side is called internal rate of return. And there can be only one value. There can be only one number, right? That will satisfy that condition, right? There can be only one number oh, come on. All right, so verbally, the number that makes the discount rate that makes the right-hand side equal to the left-hand side of this equation, that's called internal rate of return. Okay, that's what internal rate of return is. So then how do we find internal rate of return? Two ways. We can do it in two ways, right? But okay, so that would that brings us to back to sure application. Back to the slide. Okay, back to the slide and the oh no. A project's internal rate of return is the return it generates on the investment, its cash flows. All this verbal definition doesn't really matter. verbal definitions. It's just so open-ended and it's uh, not closed-ended, right? It's just confounding or just clouding your concept. As I said, internal rate of return is the rate, right, in this denominator that makes the right-hand side equal to the left-hand side. Okay, and then okay, uh, this is another thing I can use, but then it doesn't. Oh, I could have full screen. Okay, that's fine. Again, it's very hard to use. I mean, as I said, I'm using temporarily my old computer, which doesn't, which is running on Windows 10, so it doesn't support like things like whiteboard or touch screen. So it's still the same. So I'm gonna give you an example of how to do internal rate of return shortly. But until in the before that, uh, the decision rules. Of course, if internal rate of return is greater than the cost of capital, the cost of capital is um, the discount rates, the hurdle discount rate that is set by the company. Okay. Um, of course, um, uh, and in the later chapters, and which have already been covered by the main lecture, right? It's the weighted for any project, any company, is the weighted average cost of capital, because capital comes from both equity and debt, right? So if the internal rate of return is greater than the cost of capital, except, meaning cost of capital is the rational um, rationally expected hurdle rate. So if internal rate of return is greater than that, then that means you have abnormal return. Abnormal. Abnormal doesn't mean a bad thing. It's just it means higher than. It could be abnormally lower, but usually abnormal return means excess return, right? Uh, and if it is the other way around, you reject if it is less than cost of capital. And also between mutually exclusive projects or two competing projects, then if internal rate of return of project A is greater than internal rate of return of project B, then project A is chosen. Okay, so then they say um, um, how to find it. Use iterative method. Iterative method means trial and error. Take a guess and try out, input a couple of values and see whether it makes the right hand side equal to the left hand side. But then this is really trial and error method, and this is really not a uh, scientific method. This is more like uh, this is crude, right? This is crude. So we don't do that. Okay, we will never use trial and error method, right? Instead, we will. So let's do this example. If you do this example, um, and this is the example we used for net present value, and in that case, 12% was given, right, as um, cost of capital, right? So discount rate was given, and we got negative net present value, so we reject. Um, and also from this, since net present value is negative, the project's internal rate of return must be less than 12%, right? If it is greater than 12%, then it wouldn't be negative, right? Um, it will be positive and it will be accepted. Also by internal rate of return, if it is greater than 12%, yeah, accept. But it is less than 12%, so reject. And internal rate of return is basically not knowing what this discount rate is. And if you transpose this initial investment to the right-hand side, it will be 5,000 positive, and then we will need to find what is the rate that will make the right-hand side equal to the left-hand side. Okay, so I'll give you not in this. I'll give you this example. So this file is already there. This file is already there. So I want you to I want you to go to, this file is already there. You just need to look in the, if you go to topic 3 folder, if you go into the topic 3 folder in the course materials, you'll find this K budgeting, capital budgeting Excel file, right? You download it and open it, right? You must have it in front of you. And once you open it, it may not be exactly on the first sheet, first spreadsheet. There are multiple bottom tabs. There are multiple bottom tabs. So you must pick the one. You must pick the one. The first one. You must pick the first one that says internal rate of return versus net present value. Okay. So if you have opened it, I want you to delete everything in this column C. I mean, C16 through C20, I want you to delete. And also B20, I want you to delete. Where's delete? No, not that one. Just delete using the delete key. All right. So this is exactly our example. So I want you to. I'm going to highlight this. And olive, green, or drab. I'm going to highlight this with yellow. All right. So do you all have this in front of you? Do you have this file? Okay, good. So and let me check the original. Okay, 1,000, 2,000, 3,000. Okay, that's our example. And okay, and the cost of capital was 12%, so you change that. Cost of capital was 12%. Now, Then present value, we can find, we will find the present value, which is not a difficult thing. First, it is already present value. You don't have to do anything anymore, right? Cash flow at time 0 is already, in present value. You don't have to do anything, but just to give it like uniformity, just to give it uniform structure, I'll discount it anyway. But if you discount it, it's going to be 1 plus this, right? And then raised to 0, right? I've been telling you that, that symbol is the universal machine language for raising something to power, right? And that the name is caret, right? It's called caret, which comes from French carré, meaning squared. But they call it, a cone sign or hat sign or whatever they call it. It's raising something to power. And because you're raising something to 0, if you raise something to 0, it's just 1. It's just itself. So, it will be, this whole thing becomes 1. The denominator becomes 1. So it will just be, okay, 5,000. And then I don't have to repeat the same thing. All I need to do is just copy and drag it just down. Oh, I'm sorry. I forgot to lock this. You must lock this because the cost of capital is in always B15. So you must hit F4 to lock it. If you don't lock it, then it will change as you copy and drag it. Oh, come on. Didn't I lock it? I locked. F4, yeah. And then I locked. Drag it down. So we have all the present values, right? Without, you don't have to build it over and over again. Once you have built it, and then you can recycle it over and over. So there you go. And then, so the net present value is the sum of all of those. So you use auto sum, right? Sum all of that, and you get negative 377, right? So you reject. But let's find the internal rate of return. And we will use, there's Excel command, internal rate of return. We can use rate, but rate command is limited. When the cash, in this case, we cannot use rate command because cash flows are uneven. If the cash flows are even, we can use command. We can use rate command. But if the cash flow is uneven, we can't. So in this case, what we do, so you go to Excel's built-in function and look for, and go to financial. Because by default, most recently used functions will come up first. But then if you have never used internal rate of return before, it's not going to come up there. So you have to go into financial. And if you're in financial, scroll down until you find IRR, internal rate of return. Okay, so alphabetical order. So hit OK. All you need to do is just highlight all of them, right? Highlight all of them. And then there you go. You get something like, okay, there you go. So that means your internal rate of return is actually, internal rate of return is less than 12%. So that's why the net present value was negative, right? And that's why, according to our decision rule, internal rate of return is less than the cost of capital. Also, you reject. Okay? Now, but then, think about it. If the cost of capital was not 12%, but cost of capital was 8.21, then what would the net present value be? We know it should be 0 because it's what makes the right-hand side equal to the left-hand side. It's the rate, that discount rate, that makes the right-hand side equal to the left-hand side. So then let's find out if you are gonna end up with, so we'll do that again. So we're gonna now this time discounted all the cash flows by this internal rate of return, and you lock by hit F4, you lock it, and then raise to the time digit, right? There you go. Give it $sign. Of course, the present value of 5,000 is still, because it's at times, this is already present value. And as you drag it down, it's like this. And if you sum all of that, exactly 0, right? So it's out. In other words, internal rate of, as I said, internal rate of return is the discount rate that makes the right-hand side equal to the left-hand side. And if the right-hand side is equal to the left-hand side, then net present value, right, is 0, right? Okay, so that, I'm gonna, that completes our first, example, okay? I'm gonna also show you how to use, rate command, but that's when the internal, that's when the cash flows are all even. All right, any questions so far? Any questions? Any questions? Did you all get the same result?
Yeah, I got the same result.
Okay, good, good. Only one person? What about the other people? I believe, and I couldn't see, but that must have been Anna from the voice. How about you, Aisetu? You got the same result?
Yeah.
Okay, good. How about you, Ethan? You got the same result?
Yes, Professor, I did.
Great, great. Ethan, you got the same result?
Yes.
Okay, good. How about you, Kula? Did you get the same result? Kula? Hmm? How about you, Yan Chu? Did you get the same result? Yan Chu?
Yes, I did.
Good, good. All right, so the time is 10:31. So let's take a 10-minute break and reconvene at 10:41. Okay? All righty. Going into a break.
Are you using the bathroom? Yeah. Okay, let me go through your. Let's go through that.
Hmm.
Tell me when you finish coming away your bathing suit. You have to wear your bathing suit when you finish.
No, she said you have to wear a bathing suit.
What happened? What did you say? No. Then let me know when you finish, okay? You're done? Okay. Now you have to wash your hands again, you know that, right? No. As soon as you use the bathroom, washing hands is very important. It can be 100 times a day. If it's the right time, you do it.
Right now, I'm cold. It was not too tired. I thought Gabby Crawford should have been. Oh, no. Matter of fact, I'm about to just make some noodles. Alright, I'm gonna make some noodles. And I'm gonna put some cayenne pepper in there. Pack up your pomade. Let it taste like pasta. It's a pasta. When you're done with me, pasta. It's a day. Remember the first time we went to Miami, and we had went to place, and but after the storm, like I wasn't feeling nothing until the tape broke. When we was driving back, I swear to God, she just hit. Like I was so yeah, I was sober the whole time. Like that she was shooting. I'm like, oh nah, oh nah. Once I got upstairs and I went to the hotel, I was like, yeah, nah. Little elevator ride, ride me. Frizzle, no, frizzle. Like, I was like, yeah, no, I was fried.
Wait.
What time is swimming?
We have to be there at 11:30.
Oh,
11:30.
Have some yogurt, Daddy. Have something yogurt, something not too heavy. Which one?
SpongeBob?
Okay, you want this one? Good.
like,
It's cold.
You don't like this one?
No. It's down like.
why you don't like that one?
Because it's too spooky. I only like the SpongeBob one. Wait, why does SpongeBob have an eyes and a mouth?
That's googly eyes.
Like, googly eyes?
Yeah.
What? Why is there a snail on that? Why is there a snail on that?
Then it's almost the same, so why? Okay. We'll have that. Sit down and have
The
that.
same? Is it the same?
Yeah. Here.
I'm telling you, I already don't like it sick to get nasty. I can't. No, sir,
Pick it up.
I start sounding like Carisha. Like
Yeah,
just
there you go.
talking to me. I don't have no time for that.
You sit. Finish and then you put on your bathing suit and you go. Okay, Daddy? Now let me use the bathroom. Yes, you have to.
Pack up your hoodie, pomade. I want some pizza. Well, I can find it. It feels like you're home. That's exactly.
Finish it. I'm coming, okay? I'll use the bathroom. Oh, I can't finish it.
Eat today. Go away. Like some Chinese food.
There is enough toilet paper. We didn't take one.
How much is really pomade? Yeah. Okay. Yeah, would you go swim with the sharks? Wow. But you do jet ski. Okay, so we're gonna go parasailing.
Ah.
Great. Oh. What about kayaking? Why? What about people like die, like this is underground underwater cave? Why? Why are you being? Okay, you're gonna have enough float, girl. And why you can't swim? I can't swim in this crazy. And you're gonna have enough float.
Really?
I'll just stand at the top and take pictures.
Really?
Like,
Snake. Snake says.
what else swim with the pigs? Why? We'll take a cool picture doing that. Take a picture of me. Take a picture of me. I can imagine you. Look. I want to go someplace that everybody's gonna enjoy. I just.
Happy birthday, Dulce.
Mhm.
Happy birthday, Gilbert. Happy
Mhm.
birthday, Gilbert. Happy birthday, Gilbert. Happy birthday, Gilbert. Happy birthday to Paris. Happy birthday to Paris. To Paris. Back when all but Paris always here. No. Now it's Paris. That's not open and that's no. No.
Okay, Gabby, you done? Okay, let's do something. It's like you have to wear your loafers. It's easier. It's 3 parts. Okay, Gabby? Alrighty?
But what about water shoes?
What do you wear? Let me ask. What do you wear?
Water shoes for swimming.
Let me ask your mom.
Where the loafers to go and then put the water shoe on after when you get there. Oh,
Boring.
good morning. Bro, I hate people think I work with them. I don't like, bro, like, buy a printer, like, do something, stop actually do stuff.
Gabby, let's go. Let's go and let me ask your mom. Gabby, let's go. I'm calling your mom. This has to go in the garbage, Gabby.
Huh?
Hi, Gloria.
Yes.
Yeah, concerning the shoes. Does she wear the loafers and her water shoes when she gets there, or how do you do it?
She can wear either one. She can wear the water shoes or
the loafers.
Loafers, either one.
Okay.
Yeah.
All right.
She can wear either one. She can wear she wants to wear the pink one. She can wear it.
Okay.
And then, but coming back, go with her loafers. Coming back, she has to wear
exactly.
Her
so yeah.
Yeah, coming back, she go with 2 shoes.
Oh yeah. Okay. Okay, Gab. She just had a yogurt. I'm going to put the her bathing suit. You want more? She wants more yogurt.
She can have 2. Yeah, but they're small.
Mommy.
What do you want?
More because I need energy for me to swim.
Okay, that's great. She needs energy so she can swim.
Yeah, she needs energy.
Yeah, you're right. Here. Okay, yogurt is fine. It's not heavy. I'll open it for you.
Green.
What?
What's it?
Why you don't like green?
Alright.
Green is a beautiful color.
Oh.
Yeah, it's beautiful. Okay. All right. So I'll talk to you. Bill is waiting outside, so we just get ready and go.
Okay.
Okay.
Yeah, you can leave it alone. Let's get
I
to
think-
11:20.
Yeah.
Green.
I don't know how traffic is. Hold on. I'm talking. Hold on.
Hey,
I
hey,
don't
hey,
know
hey.
how.
Green is next on mine.
Gabby,
1 second.
I don't
Cool
know
yourself.
how the traffic, because traffic wasn't coming back. We have to go round and round again. So I don't know how. So immediately I finish.
Maureen!
She's on the phone. Give her a minute.
Gabby, your mommy is on the phone. Yes. You want to see her FaceTime? Okay, let me make it FaceTime.
Maureen.
You want to FaceTime it?
Yeah, I'm Yeah. Talk to your mom.
Maureen.
All right, we're back. We're back. We're back.
Oh,
Sorry
yeah,
to,
yeah.
Yes, Brent,
sorry to
secondary.
interrupt.
You're right.
No, it's called bike.
Okay.
Tyra,
Oh my God.
please mute your microphone, please. Thank you. So we're back. Let's see. Yeah, we have 5 people, right? And I'm sharing my screen. So all right. So next, let's think about another another example. And I said using basically internal rate of return command from Excel's built-in function. That's fine. But also you can do it like this. If the payments are all, I mean, if the cash flows are all the same. So here in this example, cash flows are all the same. But this is, let me delete. So the model, right above it, right? Let me delete all of that and these 2 cells. Use trap there. Okay, so cost of capital is 6%, and so we can do it in the same way, right? Present value of all of those cash flows, right? I can this one I will just okay. I will just leave it as B0 because this time okay I'll just change. Um, over 1 plus discount rate. You'd have 2 close parentheses raised 2. Yes, but then again, A2 doesn't have numerical data. It just has text. So I'm going to change A2 later. Okay, here you go. And if I change this to 0, we'll get that. And then drag it down, sum, right? And you get, positive net present value, right? If we do internal rate of return, then IRR, internal rate of return, and all of this cash flows. Yeah, internal rate of return is greater than the cost of capital. So we accept this project, and we reach the same conclusion by also net present value. If we use rate command, we can use rate command in this case. Okay. So I'll just go to let's see, rate command. All right. Number of periods we need to enter. It's 5 years, 5 periods, right? Enter that. N periods means number of n, literally number of periods. Now, payment. All of these are payments, right? And present value, this is the present value, right? Future value. In future value, we have to subtract the initial investment from the future value, because that is not that way. Only the net future value will be. In other words, this 60 is not part of the future. 60 is like the interest in the year 5, right? Interest in year 5. So only by subtracting, initial investment. What happens? Something's not. Oh, I can put payment only one. Okay, something comes out as no. This is true. What did I do previously? Let's see. Comes out as. Oh, yeah. So let's do it again. So if you see what I'm doing here, it's just like a bond, valuing bond, right? Because the cash flow is even, right? Constant cash flow, just like the bond coupon payment, right? So payment, every time the payment is the same, right? And the present value, it's already negative. You can go. Future value, it was actually, this minus 60, because the future value of the bond is only, or the par value of the bond is only 1,000, right? Not, $60 is the interest in the last year, right? So you just simply separate the internal, you simply separate the par value or the future value interest from the future value, right? Just simply separate the interest from the future value, because $60 is just the last year's interest. So if it's almost like, think about it, it's almost like buying a bond at time zero, which sells at $850, which will generate $60 coupon interest annually for the next 5 years, right? And at the end, you will get $1,000 par value, right? So that's why I did it this way, and hit enter. We get the same internal rate of return. So we can come to a conclusion that internal rate of return is just like the yield to maturity of a bond. Okay, but this will work only, the rate function will work only if the cash flows are constant or even. Okay. Otherwise, if they are not even, you can't use them. All right. Everyone got the same result? Did everyone get the same result? I hope this is not a very good thing. So, okay, great. So it wasn't a difficult thing. Next. Npv profile. Okay. Oh, just one more thing. Okay. Before we go into the Npv profile, one more exercise. So when you're comparing two conflicting projects, or two competing projects, of course, if there are two competing projects, whichever has higher net present value or higher internal rate of return, you go for the one that has higher. But here, okay, I will have to come back to this. In this example, we come to a little bit different conflicting results, because project A has higher net present value, lower net present value than project B. So by net present value, then you will go for project B. But then project A has higher internal rate of return than project B. So this is a mind-boggling situation. And I'm going to come back to this later. So project's Npv profile is a graph of its net present value versus the cost of capital. Okay, it crosses the horizontal axis at internal rate of return. Yeah. So let's take a look at this graph. The vertical axis is the net present value. The horizontal axis is the cost of capital. So, and then think about it. The lower the cost of capital, in other words, the lower the discount rate, the higher the present value. Right? Isn't that right? The lower the discount rate, the higher the present value. That's what it is showing. So as the and then I can't too much. There's no, okay. The cursor looks like this. You can see the cursor. So the higher the discount rate goes up, net present value will go down. And at internal rate of return, the net present value will be zero. Right. That's net present value. That's the definition of internal rate of return. It makes the net present value equal to 0, right? Right-hand side makes the right-hand side equal to the left-hand side. Left-hand side is the cash flow at time 0, which is initial investment and cash outflow, and all the rest of them is cash inflow, a positive cash inflows, right? So it's supposed to intersect right here, where, and then that's where the net present value is 0, and that's where you have the internal rate of return. And that internal rate of return, as internal rate of return, as the cost of capital goes up, right? Then, or the discount rate goes up, then the net present value of the project will be negative. So that's why it only makes sense if our cost of capital is somewhere here. Right? Our cost of capital will be if the cost of capital is set too high, we will have negative net present value. We will hardly have positive net present value. So the cost of capital must be a reasonable one, something that, but that's a hurdle rate. I mean, we cannot just set our cost of capital low just to justify our project, right? Because the required return is the result of the risk, right? The risk of the project. The higher the risk, you will have to you will need to require a higher return. So obviously you cannot discount a risky project, highly risky project, by a low discount rate, right? Anyway, so if our cost of capital is somewhere here, we end up with positive net present value. And also, then think about it. If our, as long as, so our cost of capital is here, and as long as our internal rate of return is higher than our cost of capital, it makes sense. You accept that project, right? It's a decision criteria. If it is especially standalone projects. However, these are some technical problems with internal rate of return. First of all, there can be multiple solutions. Unusual projects can have more than one internal rate of return. Yeah. Why? Because think about it. Solving this question, if our timeline, in other words, project's cash flow timeline is 10 years, right? There will be 10 cash flows, right? Even except the besides the initial cash inflow or initial investment, right, at time 0. Beyond that, still there will be 10 cash flows. And sometimes these cash flows may be not all positive, some mostly positive, right? Because initial investment of, let's say, $10 million, what's that? You are investing in a capital expenditure, like building a plant. And once the plant is built, right? So $10 million was used to build a plant. And once the plant is built, then it will generate income because it will produce the products. And the products will get sold, and as the products are sold, then comes in the revenue, right? That's your cash flow, right? And especially, not just the revenue. After paying off expenses, uh, what's left is your uh, EAT. And after paying off um, expenses and the interest and taxes, then what's left is EAT, earnings after taxes, which is your net profit. Of course, net profit is not all of the cash flow. Cash flow is, a little bigger than the cash flow would be greater than just the net profit because cash flow means generally free cash flow, and the free cash flow would include basically depreciation, which depreciation would add more cash flow, right? It will add more cash. Uh, so So the point is, generally, all the future cash flows will be normally positive, but sometimes there could be negative future cash flow, negative at some point. Why? It is totally possible because uh, the company runs for 5 years, and then at that point they decided to make uh, additional capital expenditure. In other words, um, expand the production capacity. To expand the production capacity, then you will need to invest again. There will be cash outflow again, right? If you want to increase the size of the plant by 50%, at least that means you will, the cash outflow at the point, at year 5, at the beginning of year 5, excuse me, or at the, excuse me, or at the end of year 5, right? Uh, will have to be 50% of what was the original initial cash outflow. And our initial cash outflow was 10 million, right? Cash outflow at time zero, 10 million. Then, there will be at least, expanding the capacity by 50%. You will need to invest again 5 million at least. So then the net cash flow in year 6, at the beginning of year 6, can be negative. So at some point it could be negative, or not because of expansion, but also the business may suffer suffer from unexpected downturn, right, in business. So then cash flow could be negative, right? Well, of course, if it is unexpected, it isn't, included in the in budgeting. I mean, if it is unexpected, how can you plan ahead at time zero, right? How can you generate such unexpected uh, cash flow at time zero, right? That's not, normally that's not the case. But anyway, another reason is simply mathematically, uh, so that's what that's what I'm doing. The number of positive internal returns to a project depends on the number of sign reversals to the project's cash flows, right? That's what I'm talking. Normal pattern involves only positive cash inflows, right? Positive cash flows. But again, also not only because of that, but also purely from mathematical perspective, right? Purely from mathematical perspective, uh, solving nth order equation. I mean, usually, um, just the second order equation or quadratic equation. We already know what's a quadratic equation. Second order, right? Let me use. Okay, so we. Okay, I don't need another one. New one. How do I get a new one? Oh, the problem of this thing is you can't. Oh, clear annotations. Okay, so this is how I get a new page, new whiteboard. All right. Quadratic equation, right? For example, function of x. I mean, if it is a linear equation, right? It's something like, it's not a difficult thing. Something like, something like 2x plus 6 equals 0. And let's solve for x. We know x will be, there's only one solution for x. X will be -3. Isn't that right? Only one single solution, right? But if it is, or even, this was probably, but if it is, quadratic function or quadratic equation, let's, without a function, right? The function equation is like x squared plus 3x plus 8 equals 0. Let's say 18 equals 0. I mean, why does it have to be? Why does it have to equal 0? Well, that's where x-axis, y cuts the x-axis, right? The y value must be 0 to find x, right? Okay. But usually, the equation function of that equation, right? In other words, if you look at the graph, it will be, it will have, and to solve this equation, um, This equation will look like something like this. Ah, I should- oh, come on. There is a way to undo easily. The x-axis. This is x, and then y. And a quadratic equation like this will be, this means when x is 0, y will hit 18. That should be 18. When y is 0, we have two x values. So in other words, solution will be x would be, there is the set of x, there will be two solutions, x1, x2, right? So think about it. As the order of the equation goes up, right? For mathematically, purely mathematically, right? Even third order, I mean, second order is called quadratic, third order cubic function, fourth order, the name, I don't know, it's just fourth order equation. As the order of the equation goes up, there are more solution values, right? Because and the third order equation is usually like this, and it could have only one. The cubic function looks like this, so it can have only, it will have one. The fourth order, fifth order, it will, be a different story. So from purely mathematical perspective, it can have multiple solutions, which is, that means, n discount rates, right? Usually, it doesn't happen because, to make this equal to 0, usually just one value, but, mathematically possible, right? It is, what I'm saying is it is mathematically possible to have multiple n values, multiple, internal rate of returns. Now, also, there is a reinvestment assumption, meaning, for this to work, right, internal rate of return implicitly assumes cash inflows will be reinvested at the project's internal rate of return. In other words, the same, all these cash flows will be reinvested until maturity, right? At the same, internal rate of return. Then that's why that's why using rate command is possible. the rate command basically assumes, all these, cash flows are being reinvested, right? Being reinvested at, the same cost of capital until maturity. And if that's the case, right? Uh, but that assumption is very, restrictive, or very, yeah, restrictive assumption, right? Because in reality, it may not be the case. Okay. And also think about it, for projects with extremely high internal rate of returns, uh, this is unlikely because how can you reinvest it? How can you reinvest all these cash flows at such a high return? Because you can reinvest it generally at the market rate, right? Capital market rate. In other words, you can reinvest it either at the going rate in the market, or um, the you can, if you put it into the stock market, you get on average the market rate, the market's return, the stock market's index return, right? Uh, the return on the index fund, right? You can earn that on average. But stock market's return on the index, the market return, there's no guarantee that and it's not to mention guarantee, but not to get the market return is some average of the weighted average of the stock market's stock every stock's return, weighted average of every stocks that's listed in the stock market. And then obviously, it cannot be as high as the internal rate of return of this project. If it is extremely high, right? If that project has extremely high internal rate of return, it's almost impractical and unrealistic, right? Ah, so these are. Oh, where's this? These are. Well, however, these are rarely practical concerns. These are rarely practical concerns because in practice, these, restrictive, as I said, these are restrictive uh, conditions or restrictive assumptions. So generally, it doesn't happen. It rarely happens in reality. So we can continue to use internal rate of return without too much concern. Well, however, NPV and IRR do not always select the same project in mutually exclusive decisions. Yeah, I showed you that a conflict can arise if NPV profiles cross in the first quadrant. If NPV profile cross in the first quadrant. In the event of a conflict, the selection of the NPV method is, yeah, when the conflict arises, NPV is preferred, right? NPV. So what it means, okay, so here, This is the first quadrant. Of course, first quadrant. You might. There are 4 quadrants, but first quadrant is normally x and y values being all positive, right? Okay, you understand? Let me. Okay. So if I can use, let me use this. Keep writing tools. Here. Draw. Okay. Okay. Yeah. All right. Let me try. Okay. It's not a straight line, but it's not a straight line. But let me make it straight as possible. Oh, come on. So I can't retain it. Okay. This is the. What happened? This is the first quadrant. Come on. Second. Why is it like this? Second. Third quadrant. Fourth. Fourth quadrant. And then think about it. If the NPV, right, of project A, if it goes like this, and if NPV of project B goes like this, what's going on? Why isn't it? It's only holding it for just 1 second, right? If project B is like this, or like this, yeah, we know this is much better. I mean, project A, we know. Project A, project B, project C. Project A is much better, right? Because it's, internal rate of return is higher than project B. And internal return of project C is even negative. Well, project C cannot be accepted, right? Project A will be accepted. Project A is better than project B. There will be no conflict if that's the case. But then, there is a possibility that, there is project B, and NPV profile looks like this, and project A uh, cuts the horizontal axis here, and project B cuts the horizontal axis here. So internal rate of return of the project A is better than internal rate of return of project B, right? But then net present value of B is better if at cost of capital. If the cost of capital is here, K2, the cost of capital is K2, and project B is better by NPV. If the cost of capital is K1, higher cost of capital, net present value of project A is better. So depending on where the cost of capital is, and both projects' internal rate of returns are greater than cost of capital A1 or cost of capital 2. So they are both, acceptable projects. But if the cost of capital is 2, K2, the lower cost of capital, project B is preferred, whereas at a higher cost of capital, project A is preferred. So this is, the decision criteria when, we have conflicting, first of all, at K2, both are greater, right? At cost of capital 2, both internal rate of returns are way greater than K2. And so, but internal rate of return, project A is preferred by internal rate of return. But then net present value, project B is preferred. And then you're in a mind-boggling situation. So what do? Go for project B, right? Go for project B because it has higher net present value. Always when there's a conflict, net present value comes, overrides or supersedes. It supersedes internal rate of return. Okay. And if the cost of capital is at K1, and both decision criteria points to the same thing. Project A is preferred by both internal rate of return method and net present value method, right? Alrighty, so the time is 11:32, so it's about time to right time to take a break. We'll take a 10-minute break, and we'll come back at 43, right? 11:43. All right, alrighty. Let's take a 10-minute break.
Professor, can you hear me?
All right, we're back. We're back. Okay, it says my connection is poor now. My connection is poor. Oh, I was sharing my application. What's happening? All righty, but you know, my connection is poor. No, it's okay now, I guess. I was talking the whole time, but there is this chat here. Tyra was asking, is he talking? Yes, I was talking. And from 11:32, we went into a 10-minute break. Okay, and I'm back now. We're back now. Alrighty, so can everyone hear me? Everyone can hear me? Audio, any audio problem? Any issues? Since Tyro was asking. Alrighty, are you guys still there? Are you guys hanging in there?
Yes.
Okay, good, Yanchu. You're there, but you're just speaking for yourself, and you're not speaking for the others. And let's see.
I'm back. Yeah.
Okay, you're back. Good. Andres, are you there, Andres? Andres?
Yes, sir.
Hey, good. I said to, are you there? I said to. I said to. Kula, Kula, are you there? Kula. All right.
I'm here.
Good. Okay, good, good. All righty. So let's take let's do the other example, the remaining example. So I want you to go back there and delete uh, delete the column G and column I, and also cells, delete, row 11, 12, and 11, right? And then I'm going to highlight again this and this, and I'll call that 0 because this is cash flow actually. Cash flow. Okay, and put a yellow highlight there. Put a yellow highlight here and here. All right. So we have two competing projects. So it will be, assuming that it is mutually, they are mutually exclusive, meaning we can accommodate only one project in the budget. So then, let's find its net present value, right? We all know the initial investment or cash flow at time 0 is already in present value, but just to give it uniform structure, I'll still discount it, but discount by 0, right? Now the cost of capital is 8%, so you're gonna need to lock it, right? By hitting F4, you lock it, and then raise to 0. There you go. And then you drag it down. Okay. So now those are present values. And here you can see in year 3, in this case, year 3, cash flow was negative again. So that means, it could have been simply net loss, right? Not profit, net loss in that year, or it could have been like there was additional investment in that year. Okay, so the net cash flow was in that year was negative, and then we find auto sum, right? We find sum using the auto sum command. So that gives us our net present value, and here we also do the same thing. Divided by 1 plus K, and lock it, hitting F4 and raising that to time digit, right? Time subscript 0 there, and then that's the present value. We drag it down, right? We drag that, and then drag it down, and then find sum of all. That's the net present value. So by net present value, clearly project B is preferred. Project B is preferred. Now let's find internal rate of return. So we use Excel's built-in function. internal rate of return, and then the values we highlight all the cash flows, and then we get 23.38%. And then here again, why is it like this? It better be left. And internal rate of return here too. These values. So to use internal rate of return, initial investment always must be entered as negative because it's cash outflow, right? Hit OK, then 18.35. So think about it. Without evaluating the NPV, you would have picked this project, right? Because simply by internal rate of return, project A has higher internal rate of return. Project B has lower internal rate of return, but then project B has higher NPV. And if that conflict happens, what did I say? The decision criteria is to go with the net present value. So in this case, project B will be selected, right? Project B will be chosen, it will be accepted, and project A will be dropped, okay? And of course, that's because we have only limited budget, right? We have budget constraint. If you don't have any budget constraint, both projects can be accepted, right? Because they have very high internal rate of return. So everyone got the same result. Did everyone get the same result?
Yes.
Everyone? Okay, good. If you got the same result, we're good. Okay. Okay. So now to the next. We did it already, We did it already. We don't need to use financial calculators. Now, so we move on to the profitability index. Profitability index is basically, the ratio between cash inflow and cash outflow, right? A ratio of the present value of the project's inflows, cash inflows, the present value of the project's cash outflows. Of course, that means if the project's cash present value of all the cash inflows is greater than the present value of the cash outflows, then that's only that makes sense. It's a net present value is greater, net present value is positive. That's the case. So in other words, to put it in another way, how do I maybe new? Okay, new. It's just new. I'm not trying to open anything. A blank sheet. I want a blank sheet. Oh, I see. I can do this. I can just open another one like this. Okay. So all this time, I've been telling you that the basically net present value is nothing but ah, stop it. Maybe I better use, give me a break. So let me use the internal whiteboard. Okay, and then so the new one. Clear, yes. And then this doesn't. So the net present value is basically, sum of all the present values of the cash flows, right? Which means cash flow at time t, 1 plus cost of capital raised to t, where t runs from 0 to n. So obviously, and then, that means cash flow at time 0 is negative. This one being negative. And the ensuing cash flows are all, positive. Present value of cash flows at time t, where t runs from then 1 through n, right? Because, cash flow at time 0 is separated, and that is, a negative. And normally, these are all positive. Okay? And then if okay, and I will need to again I need a little space here. Think about it. Then the next question is, net present value is basically, will be either, can be either greater than or equal to or less than 0, right? Depending on whether, depending on whether the left-hand side is greater than or less than, come on. Depending on whether cash flow at time 0, which is the left-hand side. I mean, if you move this to the left-hand side, right? All other cash flow, right? Depending on whether it is, less, greater than, or less than. So if the right-hand side, if all these cash flows are, present values of all those cash flows are greater than cash flow at time 0, initial investment, then net present value will be positive. If they are equal, right, which happens at IRR, right, which happens at IRR, then net present value will be 0. And then if the left-hand side is greater, in other words, present value of all the future cash flows are less than the initial investment, of course, then such a project should never be picked. Yeah. Oh, I thought this computer crashed too. So, I thought it was running on Windows 10. So, then we can think about it. So let me, I will have to then, Jesus, I'll have to clear the whole thing. And then, so that means, the ratio, if the right-hand side is equal to the left-hand side, the ratio will be 1. If the ratio between the present value of all the cash flows the ratio can be, right, this ratio can be greater than or equal to or less than 1. Okay, if the ratio is, equal to 1, that means you barely just recover your investment. You barely just recover your initial investment, right? Also, net present value is 0. If that is, the case, net present value is 0. Three possibilities. Three. If this is the case, if it is equal to 1, that means net present value is 0. Just kidding me. I'm getting a heart attack because it is so. I'm not a very patient person. When things are being delayed and being things are dragging on, I just blow the top. I just blow off, my top. And I'm trying to repress it, suppress it. So then, it really does something bad to my heart. Yeah. High blood pressure, and my heart is, pounding like hell. So, and being, this is so slow, and I'm doing it, without, even with my regular other computer, it is still, it takes so much time, but on this old computer with no touch screen, this is just driving me nuts. Okay, in this case, net present value will be 0. They just, break, the project just breaks even. And if it is greater than 1, of course, then net present value is positive. If the ratio is less than 1, then the net present value is negative, right? So this is basically what the profitability ratio is, all right? This is the profitability index, or what they call profitability index, PI. Okay, so going back to the slide. I guess you don't see. So then I'll have to switch to share screen. All right. And then that's the profitability index. So here's one more. Yeah, it's not a difficult thing. And decision rule, if PI is greater than 1, accept. PI is less than 1, reject, because, it's negative net present value, right? Between the two competing objects, or mutually exclusive projects, the one with a higher PI ratio, you accept. And then, so our example. You remember back to this example, right? Back to this example. There was the one below here. It had PI. So how do you find PI? It's easy. So all you need to do is then some of the all the present values of cash inflows or the original, and then because this is a ratio, the cash flow. I mean, you don't need to. You will need to make this negative because it is already negative, and the ratio. If this number is negative, the ratio will always come out as negative, right? If you multiply or divide by any negative number, it will always be negative. We don't want that to happen. So it's just a ratio. So we will need to make this double negative. Double negative will be positive, right? It was already negative. So just put a negative sign. It's going to be positive. Okay, then hit enter. Now that's the profitability ratio, and the profitability ratio is less than 1. Less than 1. So this project will be rejected. This project should be rejected, right? Because it doesn't meet our criteria. Where is Where is this? Doesn't meet our criteria, right? In other words, where am I again? Okay, it should be greater than 1, right? All right, so that's the those are 4 capital budgeting methods, capital budgeting. And so, any questions so far? Any questions? Any questions? Any questions so far? Anybody?
No questions here for me.
Alrighty, good. Alrighty, good, Anna. So, I just wanted to mention if you're it's still. I believe you got the announcement for quiz 2, right? Everybody found the announcement. Everybody received the email about quiz 2. No? If you go into the announcement, I think the announcement went out today. Let me turn it into student view mode. September. Yeah, quiz 2 went out today. Today is Saturday, November 13th, right? It went out today. So everyone has noticed it, right? The quiz 2 will be starting on Friday, November 19th, right? November 19th. So please watch out for that. It doesn't show on your in the assignments folder yet, but it will start showing on the November 19th. All right, everyone. Okay, then that's it for today. And I will see you guys. Have a great weekend. I will see you guys next Saturday.
Have a good weekend, Professor.
All right, you too, Anna, and everyone else. All right, I'm going to stop sharing, stop recording, and sign out.